This video is solely for educational purposes. We will not be responsible for any losses or gains you may incur. Hello everybody, in this video we'll be starting with the CMT Chartered Market Technician Level 1 curriculum. In this video we'll be starting with the chapter 1, which is the basic principle of technical analysis, the trend. Before watching this video, make sure that you get a notebook with you and a pen and you are making notes as we discuss the chapter. This is going to be really practical in nature, so we will be referring to the trading view charts very often, and I'll be discussing all the concepts in the chapter. Make sure that you are making notes and writing whatever you feel is important in the discussion. What are the learning objectives in this chapter? We'll be learning what is a trend and how do we define a trend, what are the different types of trends, uptrend, downtrend, side trend, how do you define a particular trend. After that, we will be discussing why determining the trend is important in the first place, and then we will be seeing how to identify primary trends, secondary trends, short term and intraday trends. Those are the types of trends. And then we'll be able to describe the basic beliefs behind the art of technical analysis. Alright? And the last one is important, which is the fractal nature of technical analysis. So we'll be going over all the concepts one by one, and I'm sure that you'll be able to understand everything. Okay, so earlier there used to be only fundamental analysis. We never used to have technical analysis in the initial stages because people believe that fundamental analysis is the only way which will help us in the stock market. But that's not true. With the passage of years, with the passage of time, people have realized the importance of technical analysis as well. So that's what we are going to see in detail. Okay. So technical analysis is an art. So this is something which is visible to the eye, right? So it is a form of art, identifying trends, identifying patterns, identifying the support resistance. All of these are basically different patterns. So this is an art. The art of technical analysis is to identify trend changes at an early stage. So before the trend starts, you naturally would want to buy a stock when it is at a lower price, and you would want to sell it when it reaches its top. So identifying those trends, that is what is the beauty of technical analysis. So there is one major assumption whenever you are doing technical analysis. There is one major assumption. What do you think that is? Think about it for a second. Market prices always travel in trends. This is the major assumption of technical analysis, right? That the market prices travel in trends. What does this mean? The prices are never random. The prices are always traveling in a particular pattern, in a particular trend. So this is the assumption which is made. Well, let's see that using the charts. Okay. So, right now I have the crude oil chart. Let me just go to some other. Let's go to Nestle. Alright. Now look at the chart. Just ignore the moving average. Ignore all the indicators and the volume. Just look at the chart. I'll just make it big for you all. Look at this. How is the stock moving? Look at that for a second. What do you see? It is moving in a particular pattern, right? It is moving in a pattern. How are we going to identify these patterns? Now that is something which we'll be seeing. For example, let me show you. Look at this. You see that the price is going down in a downtrend. So now that is a trend which we have identified, right? Moving on. Look at this. So the price is always moving in a particular trend. Look at this. It's going down, it's going up. It's going down, it's going up. Now this is a sideways trend. Why is it a sideways trend? Because the price is stuck between this range. Do you see that? The price is stuck between a range. We'll be seeing this in detail, don't worry. Let's see the chart. Okay, look at this place now. How is the price going? It's going in an uptrend, right? So this is what is meant by the point that the market prices are always traveling in trends. It is never random. There is a trend in the market always. Okay. So naturally, what would we want to do? We would want to buy at the bottom and we would want to sell at the top. Obviously, right? So we should be able to capture the bottom of the market and sell it at the top of the market. So that is the basic core of the technical analysis. All right. Now, there are three things which you need to keep in mind. What are they? There are the basic strategy behind technical analysis. The trend is our friend. The trend is our friend. So this is the first thing you need to keep in mind. We must always trade in the direction of the trend. If the market is going upward, you need to trade in upward direction. If the market is going downward, you need to trade in downward direction. If your market is in a range, if your market is sideways, then you are not supposed to enter the market. So you need to always keep in mind that the trend is your friend. You need to go with the trend and never against the trend. The second thing is don't lose. Don't enter into trades which you think are against your analysis or against the indicators. And then the third thing is manage your money. You need to obviously manage your risk and manage your money. You need to set a stop loss. You need to set a target. You need to have a proper system in order to make consistent profits in the stock market. I think that's easy. Avoid ruin. Now, what do you understand by ruin? Ruin means that you need to set a stop loss or anything which will lessen your risk of loss. Okay, now let's start with what exactly is a trend. So you know that there are three types of trend. Either you have an uptrend or a downtrend or a flat trend or a sideways trend. So what do you mean by uptrend? A stock is moving like this. What do you mean by downtrend? A stock is moving like this. And what do you mean by a flat or a sideways trend? The stock is staying in the same place. Now in the uptrend, we'll be seeing examples. The stock is creating higher highs and higher lows. What do I mean by higher highs and higher lows? The next high is higher than the previous high. The next high is higher than the previous high. The next high is higher than the previous high. Simple, very logical. That's why it's called higher highs, or it is called as higher peaks, right? And higher lows. Low. The next low is above the previous low. The next low is above the previous low. The next low is above the previous low. These are known as the higher lows or the higher troughs. Now that is what is my uptrend. Now let's see what a downtrend is. My downtrend is creating lower lows is creating lower highs and lower lows or lower troughs. Very simple. So in my uptrend I have higher highs or higher peaks, higher highs or higher peaks, and higher lows or higher troughs. This is my uptrend. And in my downtrend it is the opposite. I have lower lows and lower highs. Alright? And what do I mean by flat? When I'm talking about flat, I mean that the price is stuck in a particular range. It is a range bound market. It is a flat market or a sideways market. So where the price is oscillating in the same place and it is not showing any proper movement. So now these are the types of trends which occur in the market. Now let us quickly go and see some real examples in the market. Alright. again we are seeing Nestle only. All right. Okay. Look at the chart here. Wait, let me take a better example. All right. Let us look at this. What is this? Try to observe this. What is happening? The price is falling down. The price is basically going down, right? This is the high. This is the low of the market. This is the high of the market. This is the low of the market. So when a stock price goes like this, it means that it is in a downtrend. And if it is going upwards, it means it is in an uptrend. Let's see better examples of the same. Let's go to our Nifty 50 index. So Nifty 50 index is the stock market index, right? See this now. Let's go on a bigger time frame. We'll be discussing all the time frames in later videos. Alright. So now look at this. This is so beautiful. This is a proper uptrend. Do you see how the market is going up, touching, going up, touching, going up, touching, going up, touching, and again going up? So what is this? This is my first high. This high is higher than my previous high. This high is higher than my previous high. This high is even higher than my previous high. And what about the lows? This low is higher than my previous low. This low is again higher than my previous low. Higher, higher. So this is my clear uptrend, right? So that is what an uptrend looks like. Alright. Now let's see a downtrend example too. Again, we see an uptrend over here. So I hope you understood what an uptrend is. Look at this. Higher highs, higher lows. Higher highs, higher lows. Higher highs, higher lows. So this is my definition of an uptrend. Alright. Now let's look for a downtrend now. Okay. Now this is my downtrend. Now how do I analyze a downtrend? Very simple. Higher highs, lower lows, higher, lower high, lower low, lower high, lower low. Now how do I know this is the lower low? Look at this. This low is lower than the previous low. This low is lower than my previous low. This high is lower than my previous high. So that is how I identify trends. If a stock price is creating higher highs and higher lows, it is in an uptrend. If my stock price is creating lower highs and lower lows, then it is in my downtrend. Now what is sideways market? Sideways market or range bound market is when the stock price is stuck in a particular direction. Now look at this. Look at the zone right here. Look at this particular area. What do you think this is? Where is the price going? The price is in the same place, right? The price is going up here. It is stuck in this range. That's what we can see, that the price is stuck in this range. Since the price is stuck in this range, it's not creating any higher highs or higher lows or lower lows and lower highs. So this is said to be a sideways trend. So I hope you understand how to identify these trends. And I want you to go on TradingView or go on the charts and start reading the charts and start identifying uptrends, downtrends, and sideways trends. It's really easy for me to just go on internet and type uptrend examples or downtrend examples and just put that pictures in a PPT and show it to you guys. But I really want you all to understand the practical aspect of it and how do you actually identify it. That is why without any preparation, I'm just showing you the direct charts and we are analyzing them, because end of the day that is what will help you. Alright, Now let's move on to how are trends identified. So there are various ways using which you can identify trends. So that is what we'll be seeing in this entire course in the following chapters. But one of the method which is used to identify trends is known as the linear least squares regression. Don't get scared. It is just a theory part in the chapter and it is not that important. So how are trends identified? So linear least square regression. So this is one method which is used to identify the trends. So this is a statistical method. All right. So how do you actually use this? So linear least square regression is when you put some data, all right, in your Excel sheet. Let's not go into the detail because that won't be asked. And then you have variables and the values of the variables, and then it plots the points in a graph, and a line is made closer to all the points. So by doing that, you get the averages. So now that is a method. It is a statistical method which is known as the linear least square regression. So most spreadsheet softwares includes a formula for calculating a linear regression line. It uses two sets of related variables and calculates the best fit between the data, and an imaginary straight line is drawn through the data. So now that's what is done in the linear least squares regression. Why are we studying about it? Because this is one thing which is used to identify the trends. Alright, so that's all you need to know about it. Okay, now we have something which is known as the trend lines. Let us read that. Let us learn about what trend lines are. So now what are trend lines? We'll be seeing the practical of this as well. So another method of identifying trends is to look at a graph of prices for extreme points. So tops, bottoms and everything. We can see them and we can join them and we can make trend lines. So this is also another method of identifying a trend. So how are trends identified? The first method is linear least square regression and the second method is trend lines. So to make a trend line, we are going to join the major points where the price is touching again and again, over and over again, and we join those lines and then we make trend line. Let's see it. Do you see trend lines over here? Trend line. So I'm pressing the trend line and let us make a trend line. Okay. Let me see a better trend line place. Alright. So look at this now. Do you see this? Do you see how I joined this? Now I'll tell you why I joined them. Alright. So if you see this, the price is touching here and coming down. Price is touching here, coming down. Price is touching here, coming down. Price is touching here and it came down. So now this is how you make trend lines. You are going to join the points where the price touched and reversed over and over again. Alright. So let's see more examples. Look at this place again. Let us make a trend line again. Let us start from here, this point. Okay, look at this. The price is touching here and then it went up. The price touched here, went up, touched here, went up, touched here, went up. So now this is my trend line. So trend line is a line where the price is touching and reversing over and over again. So I hope you can do the homework. You need to go on a chart and mark as many as trend lines as you can. Let us see 2-3 more examples. Then this concept will be clear for you. Alright, again here. I'm just joining this. So my price came down here, came up, came down here, pumped up again, came down here, came again. So now that is how we use a trend line to identify the trend. So the trend is not permanent, always keep that in mind. Look here. The trend line broke and everything came down. So trend line is never permanent, but it stays for a considerable amount of time. So this is how you use trend line. This is how you identify trends using trend line. Alright, let's move on. Okay. Now we come to an important concept, which is the supply and demand. What do you understand by supply and demand? We all go to stores, right? We all go to stores to buy goods. What do you understand by supply and demand in that case? Let's take an example of an iPhone to make it easy for you guys. So now, you as a buyer, you are the buyer, so you are demanding for the iPhone, and the Apple store person is my seller. He is supplying me with the goods. He is supplying me with the goods. So the more the demand, the more the price. The less the demand, the less the price. Isn't this very logical? If there is a lot of demand for iPhone, I can keep high prices because people are demanding for it, so they might as well pay for it. But if people are not buying my goods, then I have to reduce my prices in order for me to attract the customers. So this is the same rule which applies in the stock market as well, that the buyer always bids and the seller always asks. So the seller asks for a price. The seller will be like, I will sell for $10, and you are going to be like, no, I will buy for only $9. So this is what is known as the supply and the demand. The same rule applies in the market as well. Alright. So the technical analyst believes that it is futile to analyze the components of supply and demand except through the price it creates. So this is how you see. So where there are more buyers, there is high demand. Where there are more sellers, there is low demand, right? Let's look at these examples as well. Back to our charts. Okay, now look at this. Look at this zone. After here, the price pumped up. So this means this was a demand zone and the buyers bought here. So this was my demand zone. At this point, my price started falling down. So this is my supply zone, my low demand zone, right? And look at here. After here, my price pumped. So this is my demand zone. After here, my price came down. So this is my supply zone. So this is how you identify the demand and the supply zones. You choose a particular point or a zone and you see whether a reversal or a movement took place from that point. So that is known as my supply and the demand zone. I hope you understood this. Again, homework. Go and mark many demand zones and supply zones in the charts. Okay. Moving on to the last two concepts in the chapter. Now we are coming to what trends are there, the types of trends, long term, short term, mid term, whatever. We'll see them now. So trends can be either short term or long term, however they can be. So if you know that we can have charts of 5 minutes, 10 minutes, 15 minutes, 3 hours, 1 day, 10 days, 1 month, 1 year, 1 week. So we can analyze the trends in different time frames as we wish to. Let's see that in the trading view panel. Look at here. I don't know if you can see it. Let me try marking it. But yeah. Where did it go? Yeah. Look at here. Here. There is 15M written here, right? So I can press on it and I can change my time frames. See, these are the time frames, time intervals which are available. Hours, days. So this is my 3-hour chart. It's loading. So I can analyze the charts in different time frames, whatever I wish to. So this is my 3-hour chart, which means that each candle represents 3 hours. This is my 1-week chart. Each candle represents 1 week. So we can analyze the charts in different time periods. This is something to keep in mind. Alright. Now one thing which you need to keep in mind is the fractal nature of technical analysis. What do you understand by fractal nature? That no matter what time frame you are analyzing in all the time frames you will be able to use the technical analysis. Alright. So let's say I'm doing my uptrend downtrend analysis. Look at this. This is my weekly chart. You can see here. This is my weekly chart. And I can see that this is a clear downtrend. Right? Here I can clearly see that this is an uptrend. So this was my weekly chart. Right? Now, let me change it to, let's say, 3 months chart. So each candle represents 3 months. Now let us try marking the uptrend and the downtrend in this chart now. This is a higher time frame, right? This is a larger time frame. So let's mark in this and check. Alright. Look at this. Uptrend. Right? Now let's go on a 15-minute chart. And let's see how we will be able to mark on a 15-minute chart. Okay. See, we have already marked in the 15-minute chart. So let's go to a different place. Okay. We've marked this. So that is what I'm saying, that technical analysis is, look at this. We can mark trends over here as well. We can mark trends over here as well. So no matter what time frame you're going to, you can mark the trends. You can use technical analysis. So this is what is known as the fractal. This is what is known as the fractal nature of technical analysis. That no matter what time frame you go to, you can use it in any of the times. This is the fractal nature. Now, if you want me to define what a fractal nature is, this ability for trends to act similarly over different periods is called their fractal nature. So the trends act the same way in any of the time frame. So that is what is known as the fractal nature. Now if you look at a snowflake, let's take an example of a snowflake. So now look at this. This is how a snowflake looks from the outside. This is what we see and we assume that this is how a snowflake looks. But if you see the snowflake under the microscope, this is how it looks. So after its each leg, it has been bifurcated into more layers, right? It has more small, tiny aspects of the snowflake. So this is something which we can't see. But if you go into the smaller petals also, you can see the, even more advancements. Now what is this? This is the fractal nature of the snowflake. Even when you go inside and see the tiniest parts itself have more parts attached to it. So this is how the stock market also. So that is my fractal nature. So my fractal nature says that the trends act in a similar way even when you go into the different time frames. Okay. So the trading markets are similar in any period that we look. Okay. Long, medium or very short. So all of them produce trends with the same characteristics and patterns. So now there is something which is my trade length of interest or my period of interest. So what do I understand by period of interest? There is a particular time period which I will be using to do my trades. If I am a long-term investor, I might use my weekly charts. If I am a intraday, I might use 15-minute charts. So depending on the kind of investor or a trader I am, I will choose my period of interest. It can be anything, right? So no matter which period of interest you choose, the trend remains works similarly. The market behaves the same way. Okay. Alright. Now let's go to some of the important assumptions which are made by technical analysts. Assumptions which are made. So first, technical analysts assume that the price is determined by the interaction of supply and demand. So they believe that the supply and demand is very much the cause for the shift in prices in the markets. So this is something which we've discussed, right? After that, they believe that price discounts everything. Now, what do I mean by price discounts everything? They mean that the price will show all the information which is required, no matter what news comes, no matter what their quarterly earnings are, no matter the technicals, the fundamentals, everything is shown in the price. Hence, they say that the price discounts everything, it shows everything, all the information related to the stock is all included in the price of the stock. Very clear? Okay. Third assumption is the most important, which means that prices are non-random. So prices are never moving in a random way. We have discussed that using the charts. Prices are never moving in a non-random pattern. They're not they are, sorry, let me correct myself. The prices are never moving in a random pattern. It is always following a particular pattern in its movement. So the price is not random. The price always goes in a trend. The price increases and decreases in a particular trend. So the price is never random in nature. If you look at the charts are linked. You never see that one day the price was 100, the next day the price was 1000, the other day the price became 0. So that is not how the prices move. The prices move in a logical manner, in a systematic manner, right? So that is what is meant by prices are non-random. Moving on to the next assumption. Fourth, technical analysis assumes that history repeats itself. So this is the most important assumption. History repeats. Humans will behave similarly to the way they have behaved in the past. So as we have seen, if this is my trend line and if my stock is going here, I will assume that the next time the stock touches here, again it will go up. Why am I assuming this? Because that is what has happened in the past. So I'm assuming that in my future also this will only happen. So this is my most important assumption, that the humans behave the same way they have behaved in the past. Okay. My fifth assumption, patterns are fractal. This is something which we have discussed. What does this mean? That whatever patterns are formed in the markets, it is fractal in nature, which means that whether it is a higher time frame or a lower time frame, the analysis or my tools work the same way. Okay. Now my sixth assumption, emotions are affected by earlier emotions through emotional feedback. What does that mean? Think about it for a second. We'll discuss it. Think about it for a second. If I buy a stock today and the price rises, I am happy and I tell others to buy the stock. Or others see its price rising and they will also buy it, thus causing the price to rise further. So actions in the market therefore is not independent, but it is related to how the market itself is behaving. Excessive feedback can cause bubbles when price behavior rises far out of proportion to value, and can cause panics when price behavior declines sharply. So, technical analysis presumes that prices will expand beyond equilibrium for emotional reasons. So, emotional reasons can also be some of the causes, right? So, if I see that Reliance has increased by 5%, the next day I will buy it. even though that happened on the previous day. So now this is something which is very much related to the emotional aspect of humans, right? So these were my assumptions. Now let's conclude the chapter. So now we are done with the chapter. Alright, let's quickly revise what we saw. So we saw what a trend is. We saw the most important assumption, which is market prices travel in a trend. And then the trend is our friend. We must always trade along with the trend, and we should not lose our money. We need to protect our capital. That is the most important aspect. We need to manage our money and we need to avoid risks and losses. And then there are three types of trends: uptrend, downtrend, and sideways or flat trend. So how can we identify our trends? We saw that linear least square regression method is a statistical method which can be used to identify our trends. We can also use trend lines to identify our trends, and we know what trend lines are: a particular point where the price repeatedly touches and reverses. And we know the supply and demand is something which is very much applicable in the market. And then we saw types of trends. We have primary trend, long term trend, short term trend. These are the types of the trends which we have, right? And let us again go into the detail of the types of trend for a second. Okay, so primary trend is my monthly trend. Primary trend is my long term trend. All right, and my short term trend, and my secondary or intermediate trend is measured in weeks or months. And the short term trend is measured in days, and the intraday trend is measured in minutes and hours. This is something which I had missed, so let me just write it down for you guys. So I have primary trend. So primary trend is the largest time frame, which is in years or months. So now this is my primary trend. Alright. After that I have my secondary or intermediate trend. So what is my secondary or intermediate trend? Think about it for a second. So my secondary or intermediate trend is measured in weeks or months. This is measured in weeks or months. What comes after that? Short term trend is measured in days. We have short term trend after that, which is measured in days. Now we have our last and final trend, which is our intraday trend. Intraday is the same day buy and sell, which is in minutes, hours, etc. Alright, so these are the different types of trend. Primary trend is always the largest trend, which is like years and months. Secondary or intermediate trends is measured in weeks and months. And then we have our short term trend, which is days, which is basically swing trading. And then we come to intraday trading, which is my day to day trading, that is minutes and hours. Alright. One more thing you need to keep in mind: who is the founder of the Wall Street Journal? This can be asked. Who is the founder of Wall Street Journal? Very simple. It is Charles H. Dow. You must have heard about the US stock market, which is known as the Dow Jones Index, right? So Dow Jones was named after Mr. Charles H. Dow because he is the father of technical analysis. Keep that in mind. Father of technical analysis. So who is the father of technical analysis? Charles H. Dow is the father of the technical analysis. Alright, I think that's about it. And we know what a fractal nature is. And these were the assumptions which we saw. So I hope everything is clear, and I know it was a lengthy video, but it was an important chapter. Now make sure to go on the charts, go on random charts, and try to mark the trend lines. Try to figure out and identify trends: uptrend, downtrend, sideways trend. Try to identify the supply and the demand zones. Don't worry, we will be going into the detail of the chapter. In the further chapters, we'll be studying every single thing in detail, but make sure to practice. Thank you.